International Accounting Standard 37 Provisions, Contingent Liabilities and Contingent Assets. We will discuss important terms, paras and examples. What is a provision? A provision is a liability of uncertain timing or amount. What is a liability? A liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. What is a legal obligation? A legal obligation is an obligation that derives from a contract through its explicit or implicit terms, legislation, or other operation of law. What is a constructive obligation? A constructive obligation is an obligation that derives from an entity's action where, by an established pattern of past practice, published policies, or a sufficiently specific current statement, the entity has indicated to other parties that it will accept certain responsibilities, and as a result, the entity has created a valid expectation on the part of those other parties that it will discharge those responsibilities. What is a contingent liability? A contingent liability is a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity, or a present obligation that arises from past events but is not recognized because it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, or the amount of obligation cannot be measured with sufficient reliability. A present obligation that arises from past events but is not recognized because it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, or the amount of the obligation cannot be measured with sufficient reliability. A contingent asset. A contingent asset is a possible asset that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. Recognition. A provision shall be recognized when an entity has a present obligation, legal or constructive, as a result of a past event. It is probable that an outflow of resources embodying economic benefits will be required to settle the obligation, and a reliable estimate can be made of the amount of the obligation. If these conditions are not met, no provision shall be recognized. Recognition. An entity shall not recognize a contingent liability. Also, an entity shall not recognize a contingent asset. Measurement. The amount recognized as a provision shall be the best estimate of the expenditure required to settle the present obligation at the end of the reporting period. An example: an entity sells goods with a warranty under which customers are covered for a cost of repairs of any manufacturing defect that become apparent within the first 6 months after purchase. If minor defects were detected in all products sold, repair cost of 1 million would result. If major defects were detected in all products sold, repair cost of 4 million would result. The entity's past experience and future expectation indicate that for the coming year, 75% of the goods will have no defect, 20% of goods sold will have minor defects, and 5% of goods sold will have a major defect. To assess the probability of an outflow for the warranty obligation, calculation of expected value of the cost of repairs: no defect 75% and the value is nil, minor defects 20% of 1 million, that is 200,000, major defect 5% of 4 million, that is 200,000, total 400,000. Present value: where the effect of the time value of money is material, the amount of a provision shall be the present value of the expenditure expected to be required to settle the obligation. Expected disposal of asset: gain from the expected disposal of asset shall not be taken into account in measuring a provision. Reimbursement: where some or all of the expenditure required to settle a provision is expected to be reimbursed by another party, the reimbursement shall be recognized when and only when it is virtually certain that reimbursement will be received if the entity settle the obligation. The reimbursement shall be treated as a separate asset. The amount recognized for reimbursement shall not exceed the amount of the provision. Future operating losses: provision shall not be recognized for future operating losses. Onerous contract: if an entity has a contract that is onerous, the present obligation under the contract shall be recognized and measured as a provision. Disclosure: for each class of provision, an entity shall disclose the carrying amount at the beginning and end of the project, additional provision made in the period, including increase to existing provision, amount used, incurred and charged against the provision during the period, unused amount reversed during the period, and the increase during the period in the discounted amount arising from the passage of time and the effect of any changes in the discount rate. Comparative information is not required. An entity shall disclose the following each class of provision: a brief description of the nature of the obligation and the expected timing of any resulting outflow of economic benefits, an indication of the uncertainties about the amount and timing of those outflows were necessary to provide adequate information. An entity shall disclose the major assumption made concerning future event and the amount of any expected reimbursement, stating the amount of any asset that has been recognized for that expected reimbursement. Thank you.